Today, my guest is Bryan Shaffer. Bryan is the principal managing director at George Smith Partners. George Smith Partners is a leading national provider of capital market services to the commercial real estate industry. And in just a minute, we're going to speak with him about capital market trends and commercial real estate financing strategies. But first, a quick reminder, if you like the show, CREPN Radio, please let us know. You can like, share, and subscribe. And as always, you can leave a comment. We'd love to hear from our listeners. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel, Commercial Real Estate Pro Network. With that, I want to welcome my guest, Bryan. Welcome to CREPN Radio.
Thank you for having me today. I look forward to talking with you.
Well, and I'm looking forward to speaking with you as well. Before we get started, if you could take a minute and share with the listeners a little bit about your background.
Yeah, I've been in commercial real estate for the last 30 years. I was born in the Midwest and I moved to California after college. And ever since then, I've been involved in commercial real estate. I've done everything from work for the RTC in the early 1990s to helping people restructure their properties, to figuring out ways of getting developments done. And really the last 20 years, it's been finding capital for people and helping them capitalize their projects. So it's the most efficient way of using debt and equity.
Got it. And could you share a little bit or kind of tell us a little bit more about what George Smith Partners, what they do?
Yeah, so George Smith Partners is a 50-year-old boutique real estate investment firm. And really what we do is we help developers and owners get the capital they need to do their projects. We do really every type of finance. We have about 50 people. We're based in Los Angeles. We cover the entire nation from Los Angeles. And really, there's a few companies in New York that do what we do, and there's a few companies in LA, and there's not really that many companies in the middle. And it's really structured finance. It's helping people figure out that ideal structure that will make their deal work, having the right equity, the right debt, and combining those together in a way that allows somebody to grow. And our, my favorite thing is watching companies grow and expand, watching a developer go from, 50 units to 50,000 units and really expand their portfolio. And over time, we're able to see that. We start with somebody and they've got 3 apartment buildings. And by the time, 10 years goes by, now they have, 65 apartment buildings, and they're one of the larger owners in the country. And it's great to watch that growth. And I think as a company, because we're in the capital markets every single day, we can really help with that.
Awesome. And as far as the lending goes, are you direct to the borrower, or do you utilize brokers, or how's that?
So we broker debt and equity in the simplest terms. So an owner comes to us and we get hired by the owner, and the owner says, I want to develop a 50-unit apartment building. I've got this much money. I think I need to raise more equity. I need more debt. Can you help me figure out how to structure this and how to do this? And really, in a way, we become their consultant and their advisor. And we go through and work, use our experience and work with the lenders in the marketplace. We know almost every lender in the marketplace. There's very few lenders anywhere in the country that we haven't worked with over the last 50 years. And so what we can do is use our relationships, our connections, and our expertise at getting things financed. I always tell people, if you're going to lease your property, you're going to hire a leasing agent. But a lot of people think, I'll just call a bank and get a loan. I don't need anybody to help me. But the truth is, to really do it correctly, you end up better in the future if you go through someone like us that understands the details and can help you understand, the benefits of recourse or non-recourse, the benefits of doing higher leverage, lower leverage, where the market is today, because it's constantly changing. One day it might be better to go to an insurance company. The next day it might be better to go to a bank. And it just depends on where the market is.
Got it. And you mentioned deals and projects or developments and projects. Is that primarily the new construction or major renovation stuff, or do you guys deal in stabilized properties, just acquiring and operating a stabilized property?
Yeah, really across the board. So we help owners and developers get the money they need, whatever stage they're in. We're really a client-focused firm. And so we come in and we meet the developer and we understand what they're trying to accomplish, and then we help them solve for those problems and those needs. So, a couple of weeks ago, we closed on a stabilized multifamily property here in Los Angeles that was about 70 units. And we also are in the process of financing ground up development of a hotel project. It's going to be over $300 million in project costs. So it's really a big range of things. And I think what our skill is being in the markets every day and knowing every lenders and having relationships with those lenders and knowing what structures will work. And so each client is a little bit different and their projects are a little bit different and what they need is different. And there's no generic, lenders look at everything as a box. So they have a little box and they try and fit your project into that box. And if it doesn't fit into that box, they just say no. And what we really understand is what the lender's looking for, what the borrower's looking for, and how to bring those things together to make it actually work and connect.
Oh, got it. You mentioned hotels and apartments. Is there any asset class that you're not working in or you don't work with as far as commercial real estate?
Yeah, I mean, really across the board. With single family, we're not really involved. Although saying that, even single family, we recently closed a $12 million loan on a single family project. It was in the middle of construction and it had some problems and they needed more capital, so we were able to come in and get them a loan. But on single family, it would have to be worth over $10 million really for it to make sense for us to be involved. But besides that, it's really every type of product. I think in my career, there's very few products that I haven't been involved in or done. Almost every product type.
Got it. And you also kind of commented on the life cycle of your clients. It sounds like you guys have kind of some long-term relationships. Is that accurate?
Yeah, it's probably in some ways like insurance, where the longer you do things, the more sources you have and the more connections you have in the industry, and everybody needs something slightly different. I mean, it's a world where from a lending standpoint, B of A might offer product A, product B, product C, but you have to figure out how to take what you have and see if it can fit into one of those boxes and work, or if you need a more specialized lender that can create something more custom. And it's always best to look at what you're trying to do, look at your goal. I mean, if your goal is to own 40 apartment buildings, the way you finance them all today is going to be different than if your goal is to own 3. And if you want to hold them forever as a family versus sell them in 3 years, again, that capital structure is different. I mean, people think, oh, I got this at 3%, or I got this at 4%, and I got a really good deal because I got 3% loan. But if you have a 3% loan, but you have a defeasance prepayment and it's going to cost you hundreds of thousands or millions of dollars to pay that loan off in 3 years, that 3% rate is worthless. You're better to have the 4% rate and more flexibility. So there's a lot of things to take into account. And same thing with recourse versus non-recourse. Is somebody grows a portfolio, if you have 3 buildings, it's okay to personally guarantee them. But if you have 400 buildings, it starts becoming almost impossible for a person to personally guarantee them. So there's things that come up in lending and in capital, and same thing holds true for equity. I mean, we help groups with equity as well, and it's really understanding what equity works with what debt. Some lenders like syndication, some lenders don't like syndication. No matter what the situation is, it's good to have somebody that understands the capital markets.
Got it. You mentioned syndication, and I'm assuming there's a variety of other structures, but I feel like syndication, while it's been around forever, it's really become kind of a focus of a lot of the multifamily space as of late. Is there I'm just trying to think if is there an ideal client? Is there a kind of a sweet spot for you guys? You mentioned kind of from $300 million to, you know, smaller stuff, single family, 10 million. Is there a sweet spot that you see that you guys are super efficient at, or is it kind of just everybody's
I
different?
think it's working with owners of multiple properties, I think, is really where we help people. Where if you're going to do a one-off investment, you might not need someone like us. But if you are in real estate as a career and you're going to grow your portfolio and expand, I think that's where we really help. That, you know, a company starts and they buy 2 apartment buildings and they've sort of maxed out their credit line, and they've used their friends and family to come in and help them buy those 2 buildings. And then they sort of hit a wall and they're like, you know, I'd like to own 10 more of these, but I don't have enough friends and family, and I don't have enough capital myself to make this work. And then that's when they come to someone like us that can help them really grow and expand. So it's not so much the size of the property. I think it's more as they start doing more and more, and their time is better spent finding new buildings and growing their portfolio, and our time is better spent finding the capital they need to do that.
Got it. The debt side of the thing is pretty familiar for me, as far as, you know, it's kind of the banks lending is all about. Can you speak to some of the other services you do? You mentioned equity, and I think I read somewhere about mezzanine financing. And can you speak a little bit about those and how those might fit into a deal?
Yeah. So again, it's understanding the full capital stack and understanding what options are out there, and everything. You know, today you talk about syndication. You know, crowdfunding has also become really popular, and we have a relationship with a crowdfunding group that we can bring into a transaction. We have institutional equity, you know, BlackRock, Blackstone, all the big players of the world, if projects make sense. And sometimes, again, when people are making that jump, like there's a developer in the Midwest where, you know, he had 2 apartment buildings when I met him. I've helped him grow that to 32 apartment buildings. And now he's going, most of his buildings are between $5 and $10 million. And now he's trying to get up to the $20 to $50 million range. So the only way for him to accomplish getting to $20 to $50 million apartments from his $10 million apartments is to bring in an institutional partner. So we're arranging a partnership. We've introduced him to several institutions, and we've got term sheets from those institutions, and we're helping him choose what institution's the best partner to go on to this next stage of growth.
Got it. And in the equity side of things, is there usually an operator level, or, I mean, is there can you speak a little bit to like what, you know, I guess would qualify, or what would make that an attractive offer? I mean, clearly the example you outlined here with somebody that's wanting to grow, needing more equity, is that kind of the recipe there? Is it somebody that's beyond what they can do?
Overall, institutional equity is very hard to get. So you need a very good track record, and you need a lot of experience. So I don't want to be deceptive to people. I mean, if you're doing your first project, you're not going to find an institutional partner. There's other ways of doing that, and that's where you get into mezzanine and preferred equity, where it's almost more of a loan, where they're giving you the money, but they're still taking a loan against the property because they can't base that on your experience. When you sort of reach that next level and you're ready for institutional equity, they're doing it based on your track record. And they want people that can prove, like, you know, I've gone to Oklahoma City, I've done 14 projects in Oklahoma City, I'm now an expert in Oklahoma City. And that's when it makes sense for an institutional partner to come in and say, you know Oklahoma City better than we do. We've got all the money. We just need your skills and your experience at running those properties. So I would say that, you know, for most people, raising equity through someone like us is very difficult. It's got to be for that person that's established that track record and is now ready to go to that next level or that next step.
Gotcha. Talking about markets, you know, you mentioned Oklahoma City, you've talked about Midwest. You know, I think a lot of what I read and hear when, you know, people are talking about how to choose a market and that kind of stuff. How do you and your lenders view markets and opportunity? Is there I mean, I'm assuming there's an underwriting thought process of certain places that, you know, or I guess, is it deal specific, or can you speak a little bit to how how the
Yeah, I would almost say it's client specific. So if you're a good developer in Los Angeles, it's actually very hard to then go to Phoenix and buy a property. I mean, we've been able to help people do that expansion and grow to a different market. But what lenders really look at is a market that you understand and a market that you have expertise. I always say, like, we get hired by people when we add value. And I think in a way it's true for owners and developers too, that if you know the market really well, you've run, maybe you work for a big company and ran 3 apartment buildings, and now you're ready to branch out and do your own apartment building. I think the thing you'd want to do is be in that market that you've already worked in, that you already know, that you understand. The biggest mistake people make is they try and follow a hot market. Odessa, Texas has created all these new jobs because of fracking. I want to move there and, build a new building in Odessa. I've never been to Odessa. I don't have any experience in Odessa, but I want to go there and now build an apartment building. It just doesn't make any sense. Where somebody that's been in Odessa and has, had a 10-unit building now wants to do a 20-unit building, that makes a lot of sense. So I would say, overall lenders like bigger markets and national, New York, Chicago, Los Angeles are the hottest markets for lenders, and they prefer markets because they're safer and they have more transactions. But overall, the real trick is more the sponsor, the person doing the deal, and making sure that they understand that market and they have some expertise or value add that they add in being in that market.
No, I appreciate you kind of dialing into that, because I think that a lot of the hype buzz kind of stuff is all about, like you said, chasing the market, the hot market. But if you don't have any sense of or expertise or knowledge of the market, to hear how the lender views it, I think is helpful. And what you're going to be up against.
Yeah, and I would add real quick that I think that I always say there's 2 different languages. There's borrower language and there's lender language, and each has a different goal. So a lender wants, they're not making a big return. They're giving you 60, 70, 80% of the money for a project and charging you 3, 4, 5% for that money. And so it's not a huge return. What they want is a safe way of getting their money out at a little bit higher return, where an owner wants, you want to double your money, you want to triple your money, you want to get a huge return on your investment. And so each has a different objective. And so when people are borrowing money, the lender doesn't really care that you're going to make 3 times your money on this project. All they care about is that there's a 90% chance or 99% chance that they're going to get their money back plus their interest. So it's sort of a different belief between the two. And they definitely, when you look at those things, you have to sometimes think like a lender and understand that, if you can triple your money on a project, it's probably pretty risky, and it's less likely that a lender is going to want to do it than more likely.
Gotcha. A couple of questions here. You've talked about some different types of deals you've done. In the last, I don't know, quarter, can you identify one of the more creative ones you've done?
Yeah. We just financed a hotel project, and it was, right now that probably the most difficult market to be a borrower on is a hotel. That as the market starts changing, nobody's ever sure with hotels. If you think about it, like a multifamily property, if you're in a strong market, it's going to lease up, and over time, people are just going to keep paying rent. So as long as you run it properly, it's a pretty secure asset. But a hotel, things can change dramatically. There's a terrorist event, there's a change in the market. People just don't travel as much. They don't need to go to a hotel. And so there's more risk there. So what we did is we financed a hotel up in Northern California, and what we were able to do is sort of prove to the lender, even though the hotel had just opened and the occupancy wasn't hitting its goals, that we did a study of every other hotel in the market, and we were able to show that through this process that there was stability in the market, and that it was just a matter of time. That 3 months out, you could already see the trends. We had about 6 months of operating income, and most lenders don't like to finance a hotel until you have a year of operating income. But we were in a really strong market, and because we had so much experience in that market, we were able to prove out to the lender on a point-by-point basis that there was safety there, and that the trends were already moving in the right direction, and that over time they'd be in a very safe place.
So the value you brought to the story is just to be able to prove out and tell that story. Is that kind of the
Yeah, I'd say having the expertise to understand, what lenders would accept that story, because 95% of the lenders out there would say we're not financing a hotel until after you have a year track record of operating that hotel. So, and this was going to a permanent loan from a construction loan. So that one of the big trends in the market today is a lot of people have these construction loans. Rates are super low. Nobody knows where rates are going to be 6 months or a year from now. So if there's a way of locking that in today, sort of pulling out your profit, locking in a fixed rate today, a lot of owners and developers would rather do that than wait 6 more months and sort of gamble where things are going to be at that point in time. So I think what we did is we knew the lenders that had to get money out, that were willing to make permanent loans today, and then we were able to help with them to create the story and the background and prove out our thesis that this hotel was going to do well, and that it was, for the lender, it was a good deal too, because in 6 months there'd be 25 or 30 lenders competing for this project. But if they would do it early, they were able to get it today. So it was really selling that story, convincing them, and proving it out. Another project we recently closed was an office building in downtown St. Louis, and same sort of thing, where the St. Louis, the downtown office market has been a little bit slow, and it's just had some issues over the years. There's been a lot of big users that have moved out, and there's a market called Clayton in St. Louis that's done really well for office, but downtown has sort of suffered. People have moved to the suburbs from the downtown. Now there's some new developments in downtown. We own, or our sponsor owned a property right by the Arch, very prestigious office building, and they tried to go out on their own and get a loan, and it was very difficult. And we were able to come in, use our relationships, and really, again, prove out that that market's changing, and long term, this is one of the best buildings in that market. And there's some new buildings coming online, and that's going to bring more people back to downtown. So being able to prove out this story, use our relationships and our expertise, we were able to get them, a 3% loan fixed for the next 10 years with some interest only. So, I mean, it was a huge win for them. It cut their costs and gave them stability moving forward.
And as far as terms and length of the loan, do you find that you're able to get longer rate locks, or I guess you'd mentioned earlier, it kind of depends on what the client's goals are. Maybe you could speak more to kind of what the range of, or maybe the question should be more about just what are you seeing as far as just the current rate and terms and kind of the terms available.
Yeah, and it's a very interesting market right now. I mean, about I'd say the end of last year, so I guess that's about 10 months ago now, rates were going up, and everybody was fearful that the Fed kept raising rates, and they were going to go through the wall, and we were going to be at 8% interest, and all these people had all these fears. And our number one request was, give me a 15-year loan, that I want to lock in this 5% rate for as long as possible, because I think rates are going up. And then the early part of this year, people started to realize, wait a second, the economy is really not doing that well. We're starting to have a trade war. There needs to be some adjustments by the Fed. Maybe rates aren't going to keep going up. And the Fed came out and said, we see problems in the market. Trump's got this trade war going on that's impacting the market. All of these factors are coming together. We need to start lowering interest rates. So interest rates started moving down very quickly. And it's interesting, the people that wanted, to lock in that 5% for 15 years now think that 3.5% is maybe too high and that things are going to go lower. So it's been interesting. What we've really seen is when the Fed first started cutting, there was a big move downward. And, on the best properties, you could get something in the low 3% and lock that in for 5 to 10 years. And what we've seen, though, is lenders have now taken a step back and realized that we are in a declining rate environment, but there is a floor on where those rates should be. And I would say today the best properties are probably closer to 3.5% and edging up closer to 4% on most loans. So I always say between 4 and 5% is sort of the standard interest rate when you figure in the risk of owning a property, and then you're going to adjust up or down depending on the situation in the market and the situation with that specific property.
Gotcha. No, it's interesting just how, volatile or just how reactive the markets are. And my curiosity, I guess, with that is, are you still seeing plenty of capital available? That's kind of the thing that I keep seeing, is that the money's all chasing a rate or some sort of return, and there's just so much money in the market.
Yeah, no, we're in a very interesting market. So I would say that if you just went to a standard bank and applied for a loan on a multifamily deal 6 months ago or a year ago, and you applied today, the process is going to be slower. The bank's going to be more cautious. So what we're seeing is we're not seeing banks say there's too much risk, we're going to increase the cost. But what we're seeing is they want to be in the market, they want to look at the deal, but then they want to take their time and analyze it and make sure they understand the risk associated with that deal. I think lenders think we're closer to the end of the cycle than the beginning of the cycle. I think 5 years ago, 6 years ago, we were coming out of a recession and people felt pretty confident that we were going to ride a wave, going up. And I think now we're looking at, we're getting close to the end of that wave. It's been a long run and it's been a long spurt, and it's continued to move up. And what we've also seen is, properties like areas like Los Angeles that were hot 2 or 3 years ago have cooled a little bit, and properties that were at, what we call higher cap rates, people were demanding higher returns for those properties in the Midwest and in the secondary markets. Those have started to catch up a little bit. So we've seen stronger markets in the Midwest, in the oil belt, in Texas, and we've seen the core markets, nothing go wrong, but just sort of slow a little bit, where the velocity isn't what it was 2 or 3 years ago. So it's more now people, Los Angeles went where you could get a 5% return to now you get a 3% return on your investment. People have stopped at the 3% return and said, I can't go any lower than that. We're not seeing escalations anymore. We're not seeing people take more risk and accept lower returns. But in markets like Texas, where you used to get an 8% return, people are willing to take a 6% return now, or 5.5% return. So we've seen values go up in markets like Texas, where returns were historically higher, and it's condensing down. It's interesting. In the last cycle, we saw that immediately, where 2002 and 3, values expanded out pretty much across markets. LA became hot, and then all of a sudden, the areas outside Phoenix would become hot. And it didn't take a long time for that to happen. This cycle, when LA became hot, people still said, I got burned in 2009 in Phoenix, I'm not going back there. So the core market stayed very hot at the start of this new cycle, but the outer markets of that core market didn't grow that much. And, Las Vegas, Phoenix were still very much a big difference. You'd get a 5% return in LA and a 9% return in Los Angeles or in Phoenix. And now those have shrunken, where they're all closer together. So you maybe get a 3% return in LA and a 4.5 to 5.5% return in Phoenix. So they've come together a lot more. And I think as we see that, people are thinking we're closer to the end. You know, it's unlikely that Los Angeles is going to go to a 2% return, and it's unlikely that Phoenix is going to go under a 4% return. So we're probably hitting that top part of the market. There's not a lot of upward movement or downward movement really in cap rates.
Right. No, it is kind of an interesting thing to study the compressing cap rates, and you know, I'm kind of curious on some of those more compressed cap rates. Do you typically see those to be shorter term deals, or you know, if you were lending on somebody that was looking for a more compressed cap rate, would they typically be looking for a shorter term? You know,
it really depends, and you know, people are always trying to prove the connection between cap rates and interest rates, and it's really hard to prove. It is. I mean, it's much harder. You know, at the end of last year, when interest rates were in the 5% range, it was really hard for somebody to go in and pay a 3% cap rate. You're losing money just in interest.
Right.
So what we're seeing is as rates have come back down again, that the 3% deals are more attractive. And like I said, logically, you would think people would try and lock in that long-term rate. And there are some smart owners that are doing that. But a lot of people, you know, try and catch these waves, and they're worried that, well, rates are, you know, the bias is towards the downside instead of the upside. So I don't want to lock in a 4% rate today because it could be 3.5 tomorrow. And I personally think that's the wrong way to look at it. I mean, I think you need to look at, if you're buying something at a 4 cap, you want to lock in a 3.5% rate as long as you possibly can, because that's going to give you, you know, some positive return on that investment. And if rates go up to 5%, it's going to take away that positive return. So you don't want to buy something at a 3 and not have it grow and then get stuck when rates start going up again.
Yeah, because I think that while you know, we're in this plentiful kind of a boom, or the tail end of a boom, or however you want to say it, the wave's been going up. You know, that to look forward and kind of do the calc like you just were outlining there. If you know, if all of a sudden rates go up and the demand for your property, because people can't get the spread, goes down, that doesn't improve the value of your. I mean, even though you can prove it through NOI, and that the market cap rate will still reflect demand, will not.
Yeah, no, you're 100% right, and you can't offset that by increasing the NOI, but it's the markets are changing over time. And you know, I was at a meeting yesterday with the head of the Federal Reserve of San Francisco, and it's very interesting. I mean, they're looking at this phenomenon, and it's really caused by employment, was the bottom line of what I took out of their speech yesterday, was that, you know, as we look at over a long period of time, employment isn't growing the way it used to. So no matter what other economic factors happen, how productive people are, how many other changes happen, that we're just in a society now where you're not going to have those big bursts of employment. And so it's sort of changed the dynamics for inflation and growth. You know, historically, you know, U.S. growth over the last 50 years, the target has been like 3.5%. But since the Great Recession, it's been much closer to, you know, 2 to 2.5% growth. And what the Fed thinks, and I agree with them, is that employment is that key factor, that we're never going to be at the type of employment levels. We have an older population. There's so many factors that play into it. But the bottom line is that labor inflation is not going to grow the way it has in the past. There was some feeling at the end of last year that we were starting to see wage growth, but even as we've seen unemployment shrink to historically low levels, we just haven't seen the wage growth come into play. And so I think as you look at that at real estate markets, you're probably going to see over a longer period of time, less volatility. You're going to see cap rates stabilize, and capital also now, because of crowdfunding and because of all the different ways people can raise money online and the large amounts of capital can start becoming more efficient and hitting those smaller markets when they need that help. And so as the world becomes more efficient and as it becomes more digital, it probably adds an extra layer of stability. And it's interesting because Europe has had that for a long period of time, where the property markets overall in Europe are more stable than they are here in the US. And we've always been more of a cowboy market where, it goes up, it shoots down, it goes up and down. And in Europe and the rest of the world, property's been more stable. And I think over time, we're going to see that stability impact the US market, and where there aren't as big of jumps, there aren't as big of cap rate variations between one market and the other.
No, it's interesting to kind of take a look and see what, how the formation of all the capital, like you mentioned, and just, more of a long view of things and some stability. Let me ask you on a typical deal, and then kind of on a, an absolute best case scenario, what kind of timeline do you see it taking from first meeting with a client to closing a loan?
And that varies too, where, a typical bank loan is a 30 to 45 day process to close. And it's probably another 30 days to underwrite. What we do is we come in, we understand what they need, we underwrite the loan, we underwrite the package, we underwrite them, and then we present that to a group of lenders. And then if you're doing a normal bank loan, that's a 30-day to 45-day process to close after you select the lender. So I would say overall it's probably a 90-day window, but there are exceptions when somebody's looking for a private loan, when somebody's going through a bankruptcy, foreclosure, or some sort of bad incident. There's loans that we can close as quickly as 5 days. I mean, I'd say every year I probably do 10 to 20 private money loans that close in 10 days or less. So there are situations where you do really quick transactions. That's usually to solve a problem. The other time people use private money is if they want to buy a property, they go to the developer, they'll say, I'll buy it all cash. And so they get a better deal on the transaction, and then we get them a loan that could close really fast, so they can exercise, to the seller, they just think they use their own money, but realistically, they've, used a private money lender that can move really fast. So I would say overall, it's a 90-day process that people should look at. And on a development project, it's a longer window than that. I mean, it's probably 3 to 6 months. You should start early on if you're doing a development, because it's a long process to go through the stream.
Got it. Hey, Bryan, if we could, I'd like to shift gears here for a second. As I mentioned to you before we get started, by day, I'm an insurance broker, and work with clients to assess risk and determine, what to do with the risk. There's 3 typical strategies we utilize. One is you can avoid the risk. 2 is we can minimize the risk, or the third option is we could transfer the risk, which is essentially what an insurance policy is. And recently I've started asking my guests if they could identify what they consider to be the biggest risk. And just to be clear, I'm not necessarily looking for an insurance-related answer, but I'd like to ask you, Bryan Shaffer, what is the biggest risk?
To me, I mean, we're in a risk-reward business. I mean, people get loans based on the level of risk. If it's a very risky loan, you pay 12%. If it's not such a risky loan, you pay 3 or 4%. So we're always also looking at risk. But as I look at a more global risk to my business and really to the market as a whole, I think you've got to think about the economy and what causes a real estate downturn and what influences a market to go from being a very hot market to a very cold market. And really, it's activity. So when activity dries out, when people stop buying properties, people stop selling properties, and people have fear, when people have fear, they don't move. And as you said, like the insurance provides a level of safety for those people. So they can sleep at night and say, if my property burns down while I'm sleeping, I'll be okay because the insurance will cover that. And then I think when you look at the real estate market, the risk is really people becoming too fearful that it's no longer good to buy, that there's no upside in buying, and that can happen really quickly. It's 2008 was probably the best and the worst real estate market in the last 40 years. So you had everything peaking out and reaching its height, and then all of a sudden people's attitude changed and they decided that there was too much risk to keep buying properties and keep growing their portfolios. And that risk impacted lenders who then took a step back and said, there's too much risk to lend. And then once they said there's too much risk to lend, it froze the entire market. So I think everybody's got to plan for and know that there will be a day again where risk outweighs reward, and you have to plan for that. Just like you buy insurance, you've got to have a margin of safety. People that are well capitalized, I've never seen lose a property, but people that buy on a whim and aren't sure what's going to happen tomorrow and don't have the money if there is a bad year, get burned when there is a bad year. So to me, the biggest risk is that change in the marketplace that freezes everybody. But the solution to it is just like buying insurance is a solution to knowing that if there's a fire, you'll be safe. The solution to being a real estate investor is balancing your capitalization with the amount of your outflows. You should never be at a point where if something goes wrong tomorrow and it can't be fixed for 6 months, that you're out of business.
No, I love that. Clearly there's many examples of, like you said, people that lost everything in 08. And then there's plenty of people that not only did they survive, they thrived because they were well capitalized, were able to take advantage of a lot of the mistakes that others had made. So it's definitely an excellent point. Bryan, before we wrap up, where can the listeners go if they'd like to learn more or connect with you?
Our website is gspartners.com, and they can reach me. They can call me. I'm at 310-867-2906. Email me, or my email's on our website, and I'm always happy to answer questions. Our job is really to help people grow their business and get more properties and sort of fulfill their dreams. And that's what's rewarding for us. It's so great to see a developer put up a new building or somebody grow their portfolio, because we feel like we're part of that team.
Awesome. Well, Bryan, I can't say thanks enough for taking the time to talk today. I've enjoyed it and learned a lot, and hope we can do it again soon.
Thank you so much. I appreciate it.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.